We have some more committee moves to hit. Joining us now is Kevin Simpson of Capital Wealth Planning. Kevin, what do you got?
Well, it's been a busy week, huh, Frank?
Absolutely. Absolutely.
So we added a new position this week in waste management, old school moat company, just the kind of stock that we like. Top line beat on earnings, bottom line beat on earnings. They're expecting and forecasting high single digit, low double digit earnings for next year. With inflation coming down and non-cyclical industrial, it just plays into our theme of really looking at the infrastructure bill, Infrastructure America, and this kind of hedges Caterpillar and John Deere, which if there is a bit of a recession or any kind of pullbacks, this gives us a little bit of a hedge in the industrial space. The other thing I will mention is that they've been increasing the dividend over the past 5 years by about 8% per year, which is something that really checks the box for us.
Yeah, Kevin, I was going to ask, I always know you to be a dividend investor. Dividend here only 1.6%, but you also like companies where the dividend increases. So you mentioned it's a hedge on Deere. We have a Deere bull right here. Jim Lebenthal, what do you think about this idea of waste management being a hedge?
I'm not sure I see it. I mean, I can see waste management as standing alone on its own merits. By the way, Kevin, just side note here, is that a dog barking in the background? Because a little bit of show business insider tip here. If you're pitching a stock, you don't want to hear a dog barking.
Not this time. I mean, usually there is a dog in the office, but not today. Speaking of which, you know, like you, Jim, I own Caterpillar and Deere right now. So, I mean, I'm leaning into it. But I think if we're talking about something that's a little bit less cyclical, you know, waste is something that we always have to deal with regardless of what's happening in the economy.
Yeah, speaking of, I want to get some of the other moves. You bought more Caterpillar. You own some of that, as you said. I want to talk about your other one, IBM. Legacy tech there. Also, kind of more your kind of wheelhouse here. Big dividend here, 4% dividend. But why buy IBM right now?
Well, I know Stephanie likes it as well, but we're looking at a stock here that pays a 4% plus dividend. You've got a forward multiple of 17. They kind of broke out of a trading range that they'd been in for 3 or 4 years. So this is a stock that absolutely was behind the 8 ball when it came to AI. But it seems to me like the acquisition of Red Hat is really providing some synergy that's allowing them to participate once again. They are not part of the Magnificent Seven, and if this broadening that we're starting to see, this broadening out continues into 2024, then we expect that this can be a beneficiary of that. And to your point, Frank, it's old school tech, and we're an old school firm.
All right, so Link, you got a big position in IBM as well. What do you think about him buying at this point?
I actually don't think it's old tech anymore. I think it used to be all about mainframes, but now it is about AI, data center, cloud, and Red Hat for sure. So I like the story. I like the story a lot. I think it's cheap, not as cheap as it used to be. It's also had a 35% run since the May lows, but it's still only up 16% on the year. So it's been a big lagger after being one of the best technology companies last year. So, but overall, I love what the company is doing. 75% of the total revenues is consulting and software, and they're increasing their recurring revenue as well, which will help margins. So I'm there with you. I think it's a good idea.
Jim, what do you think? 4% dividend?
I think IBM is something that we all need to be taking a look at, and we are at Cerity Partners, a very strong look at it. You mentioned that it is still cheap at 16 times, but you also said it's not old tech. If it's not old tech, that 16 times multiple is going to go a lot higher. Now, the one thing that has always been a little bit squirrely for me about IBM is the balance sheet. They have a lot of debt on the balance sheet. In my opinion, that's what's held the multiple back. But you got to understand what that debt is for. It's to finance client acquisition. So it's not like, you know, they're using it to buy pencils and notepads. So I think there's a lot of interest here, and it's not just you, Stephanie. It's not just you, Kevin. A lot of people are talking about IBM. It's on everybody's radar screens.
They're guiding $10 billion in free cash flow by 2025. That's pretty nice.
Yeah.
I mean, I understand your debt concerns, but
I'm not that concerned. Just to be clear, I'm saying that historically, that's why the multiple's been so low.
Brian, what do you think about these two moves? I know you are a bit of a believer in waste management, right?
Yeah, we've owned waste management in various portfolios for about 10 years. We just think it's a great defensive name to own, especially within a sector, industrials, which is the most eclectic sector in the S&P 500. And we are probably less bullish on global growth the first 6 months of the year, so I think it's going to be more difficult for the cats and deers. We own Parker Hannifin's, more our play on the machinery side. But with cash flow yields above the dividend yield with respect to waste, that's the kind of stock you want to buy in a dividend growth environment, which I think dividend growth is going to have a huge comeback next year, like huge. It's going to be great.
It's been terrible this year.
So speaking of dividends, Kev, you're all about the dividends. I want to talk to you about one of your other moves, covered calls on Coca-Cola. Give us the elevator version of why you're doing that right now.
Well, we always try to write covered calls, Frank, when we see a little bit of volatility. And there was a situation where Coke had come down, almost fell off the cliff at $53. We went in and bought the position. We got some nice premium on it. We have a $59 potential exit here today. It's only on half the position, but it gives us an 11% trade on it. Sometimes you get called away on things. It's a stock that we like. We're still going to own it, but we have no problem taking a little bit of profit here. And Brian, I'm going to pray that from your mouths to God's ears with dividend growth. That's the world in which we live in. And it seems like this week's the first time we've gotten a pulse on anything. Caterpillar's up 20 sticks this week, and I very rarely get a chance to say that.
You know how it works, Kevin. You talk to wealth advisors, and they sell whatever didn't work last year, and then they buy whatever. And we saw that last year in some of the tactical money that we ran, and they bought dividend growth. And the inverse, I think, is going to happen this year. I think dividend growth and value and small cap is going to have an amazing year in 2024.
All right, Kevin Simpson, Waste Management, Caterpillar buys, sold the covered calls on Coca-Cola. Kevin, great to see you as always.